If you want to improve the accuracy of the market entrances and learn how to find powerful liquidity zones, then this video for you. Today I will explain you fellow volume gaps, what it is, what are the types and which fellow volume gap to trade from. And at the end of this video I will share with you step-by-step strategy that will help you apply fellow volume gap in practice and take your trading to a new level. Are you ready? Let's do it. First of all, let's talk about theory. What is it, fellow volume gap? Fellow volume gap is formed when prices move sharply up or down, and in the process of this movement, unfilled price levels remain. Such a gap indicates the dominance of buyers over sellers and a potential area where the price can return before continue to rise. You can notice there is an empty space or gap between two adjacent candlesticks, which the price often tries to fill. And what is the logic of fellow volume gap formation? In general, this means traces of major players. When fellow volume gap is formed, there is an imbalance in the market. The task of the market maker is to fill this imbalance. And after filling this gap, the price usually reverses that to achieve external liquidity. It can be swing high or swing low. And now let's talk about types. What types are there? First type is one-side fellow volume gap. One side means when all three candles have the same direction and the same color of candle. When we see that all three candlesticks are the same color, it tells us that one side of the market, bullish or bearish, dominated. And this may indicate the state of buyers or sellers. And in conclusion, this may tell us that this is a strong fellow volume gap, from which we can wait a strong reaction. And the second type is two sides fellow volume gap. Two sides means when three candles have different side and different colors. For example, first candle can be bullish, the second candle can be bearish, and third is bullish. But what is the difference? When all these candles are different, it tells us the different side of the market participating during the formation of this gap. It can say that the gap itself is not so strong, but we can also expect a reaction from this. And third type is break structure gap, or BSG. It is the same gap or one side or two sides. It's just that this gap is formed when we have a market structure shift. Logically, it looks like a market structure shift plus fellow volume gap one side or fellow volume gap two side. And this is another example. As you can see, it was market structure shift plus fellow volume gap. Price made pullback, balanced the market, and continued to grow. And the fourth type, inverted fellow volume gap or balanced price range. Inverted fellow volume gap is formed when the fellow volume gap becomes invalid. You can see how fellow volume gap closes the other. Let's look at this example. As you can see, what's formed fellow volume gap. Usually it's called manipulation fellow volume gap. This gap sip of liquidity, and after sip of liquidity we can see how this gap formed but from the opposite side of the market. And this gap overlaps with manipulation fellow volume gap. Let's pay attention to this example. As you can see, was formed bullish fellow volume gap. After a while, the price broke through this gap and it became inverted. And we use this level as a short position to enter. Price pulled back to this zone and continued to move down. Logically, these areas may indicate a change in market movement, indicating a potential reversal in the market trend. Higher probability inverted fellow volume gap occurred when price sweep of liquidity, and then you can notice fellow volume gap one side. Let's look at this example. The price formed bullish fellow volume gap, which sip buy side liquidity. After a while, formed bearish fellow volume gap, which formed inverted fellow volume gap. After breaking this level, the price did pullback and continued to move down. I prepare for you a free course. Scan the code and go to the Telegram channel. See the attached post and click on free course. In this course you will get 14 lessons that gave me deep understanding of the market. And I will also give you 6 strategies. Choose only one and mastery. Plus I share with you my favorite ebooks and indicators. And now let's talk how to mark fellow volume gap. Fellow volume gap is free candle formation. We should mark between first wick and third. Pay attention at this example. We start drawing from the first candle and finish with the third. That is, our task is to mark the empty space. If you're a beginner and it is difficult for you to draw it, I can advise you indicators that I personally use. The name of this indicator is fellow volume gap by nephew Sam. As you can see, this indicator draws all fellow volume gaps. And now the most popular question. How to understand which fellow volume gap to trade. To understand which fellow volume gap to trade, I use fixed range volume profile or premium discount zone. If you look at this picture, we saw a horizontal volume that will show high trading zones. Usually it is magnet for the price. Or you can use Fibonacci premium discount zone to look for the first fair volume gap in this discount zone. I wrote more detail how to use FVG and premium discount zone. Watch free course and find this lesson. And where you can find FVG and premium discount zone. You can find these tools in trading panel. And the right photo is just setting of premium discount zone. And now I share with you step-by-step strategy that I personally use. I think many people who learn ACT heard this phrase. A market is moving from ERL to ERL or from ERL to ERL. Let's figure out what does it mean. The logic of this phrase is simple. The price moves from imbalance to liquidity. When in the market there is imbalance, the task of market maker balance this gap. ERL means internal range liquidity or fair volume gap on high time frame. And ERL means external range liquidity, which is swing high or low, or liquidity. In ICT usually use 3 time frames. Higher time frame, which is weekly or daily, that identify bias. On medium time frame, it can be 4-hour time frame or 1-hour time frame. Usually ICT traders find point of interest. It can be fair volume gap or order block. And on lower time frame, it can be 15-minute time frame, 5-minute time frame, or 1-minute time frame. People use this that identify interpoint. And now let's talk about more detail. Step 1. On middle time frame, it can be 1 hour or 4-hour time frame. We are waiting for the fair volume gap will be formed. Step 2 is we wait when market maker deliver price to this zone, and our task is identify signs of reversal. In this example, we can see that price filled the gap. And when price fills the gap, our task identify signs of reversal. It can be SIP of liquidity plus market structure shift or inverted fair volume gap. In this example was formed market structure shift. You can open position market when you see market structure shift, or you can set limit order from fair volume gap. This is only an example. Let's fix the knowledge on real trading. I will test the strategy on Nasdaq 100 using 4-hour time frame to find fair volume gap. And after filling this gap, I switch to 15-minute time frame to identify interpoint. So let's watch at the overall picture. As you can see, on 4-hour time frame was formed fair volume gap. And let's switch on 15-minute time frame and wait for the price to fill this imbalance. Right now I see that price created market structure shift plus inversion fair volume gap. Let's mark it and open market order. And I marked ERL because after filling fair volume gap, the price tends to ERL that SIP of liquidity or update high or low. As you can see, price pulled back to inversion fair volume gap and I open another order. And let me explain you why I do this. When you're afraid to miss the interpoint, you can open a market position after forming a market structure shift. Risk of only 1%, but you can also open a limit order from a more profitable position. For example, from fair volume gap or inverted fair volume gap. Thereby, you're risking only 1.5%. It's not so much, but you can earn much more and more profitable. And now let's continue testing this strategy. So, okay, as you can see, below there is 4-hour fair volume gap. Let's mark it and switch to 15-minute time frame. I mark it like ERL because it is internal range liquidity or fair volume gap. And now let's wait when price fills this imbalance. Now I mark swing high. If the price breaks this level, it means that market structure shift has been formed. And as you can see, this level was broken. Now I marked order block and now I can open market order. Right now price moving really slowly, and now I want to put my stop loss to break even. Okay, great job. Take profit was achieved. And let's continue testing this strategy. And as you can see, on 4-hour time frame was formed inverted fair volume gap. And let's switch on 50-minute time frame and wait when price fills this gap. Now I marked swing low. If price break this level, it means that the market structure shift has been formed. Right now I see that price created inverted fair volume gap, and I want to open a market order. So okay, great job, take profit was achieved. You could open another order from inverted fair volume gap, but I forgot to open it. Right now I see that price create fair volume gap. Let's switch on 50-minute time frame. Now price filling this gap, and now my task is waiting signs of reversal. As you can see, was formed market structure shift and inverted fair volume gap. It is really good position because I can open position from inverted fair volume gap. Great job, the profit was achieved, and now let's move on the end of this video. I hope this video was useful for you. Don't forget that the market likes patient and disciplined traders. Trust the process, be patient, and success will not be long in coming. Thank you for your attention, see you again.